Joining us right now are two of the bill's architects, the Office of Management and Budget Director, Mick Mulvaney, and the White House Council of Economic Advisors Chairman, Kevin Hassett. Gentlemen, it's good to see you.
It's great to be here.
Thank you so much for joining us. And you know, you look at what has taken place in terms of animal spirits on the business side, where businesses are investing once again in their business, and you actually do see an impact. Has that been the biggest impact from your standpoint?
Yeah, absolutely. If we look at the economic data, the big thing that we see is that the capital spending explosion that we predicted would happen, which is ultimately going to benefit workers because the jobs are coming home and the wages go up when there's more capital. It's happening already. In fact, if you look even at foreign direct investment, it skyrocketed in the first quarter because not only are American firms putting their money back to work in the U.S., but foreign firms are as well.
Mick, is that how you see it?
Well, you add to that the confidence levels. The business, individuals, everybody looks at the government now and says, you know what, they're not out to get us. They're not going to stick it to us. They're actually going to let us succeed and let us prosper without getting in our way. And that's why you see consumer confidence up, business confidence up. Foreign investors now have more confidence in the United States. So it's exactly what we hoped it would be.
Throughout the whole process, a lot of people kept saying, how do you pay for this? How do you pay for this? And you kept getting that question all the time in terms of the $1 trillion deficits that we're seeing. What can you tell the American public about that and how worried you are in terms of the spending?
Still worried about it. I'm going to be worried about it. Anytime you're looking at $20 trillion in debt, you have to take it very seriously. But look what happened in April. We took in almost $500 billion in a single month. It was the largest take by the United States Treasury in history, and we don't even think that has anything to do with the tax bill yet, because the tax bill hadn't been in place long enough. That was the growth that came in the previous year, largely from the deregulation and just the fact the president was the president and not President Obama in office anymore.
Can I add one thing about the revenue, too, which is that if you look at the corporate side of the tax bill, there was an individual side where workers got pay cuts or tax cuts, and then there was a corporate side. Well, the corporate side only costs $400 billion, according to the Joint Tax Committee, and right now the 10-year revenue estimates are that there's more corporate tax revenue coming in than they thought a year ago. And so the idea that the corporate tax cuts would pay for themselves seems to be in the data already. But when you look at the Democratic opponents of the bill, then what they do is they cite the overall costs, which was $1.4 trillion, and say that was this big corporate tax cut, a giveaway to the rich and so on. But, you know, of the trillion, about $700 billion was a refundable child credit, which is something that in the past has had broad bipartisan support because it gives money to families. And so that's where really the thing that did increase the deficit so far was the refundable child credit, the $700 billion to that, which is something that I think, you know, there's social justice concerns that made people want to vote for that. But again, the talking point of the Democrats is that the corporate tax cuts burned a hole in the deficit, and that's just false. It's not consistent with the data.
Now, we saw this week the first quarter was a little softer in terms of growth than we thought, although, to your point, capital expenditure a little better than we thought. Right. Now we're looking at the second quarter, and some of these regional Fed banks are saying 3-4% growth. Some private economists are saying 5% growth. This is the
the Atlanta Fed, 4.8%.
Yeah, this is the hitting fives that the president has talked about occasionally. Should we be curbing our enthusiasm, or do you think it's really this good right now?
I think that what I like to do when I'm looking at the GDP data is just look at the year-over-year data so that the quarter number doesn't get me too excited. And I think that the odds of the year-over-year number being north of 3% once we get a second quarter of 4.5 are close to 80 or 90%. And once we get to that 3% growth for a whole year, that's really a historic event, something that the Democrats said President Trump couldn't possibly accomplish.
Let's not ignore the fact that when we wrote the first budget about a year and a half ago now, we didn't think we'd be at 3% annual growth for at least another year, maybe 2 years, so actually ahead of the schedule that everybody said was way too optimistic to begin with. I gave a speech last night and pulled the quote from Paul Krugman, who said when we introduced the budget for the first time in March of 17, that you could make him dictator of the country, and he could not get to 3%. So thankfully he's not the dictator.
Well, that's a scary thought.
This is the same Paul Krugman on election night said, you know, when will the markets come back? Never.
Yeah. You had a slightly different take that evening, as I recall.
Yes, I did.
At some point, you get to stop listening.
But
to
let me
people.
toss in one thing on this, which is like if there's something almost historically unprecedented which has happened, which is that growth has come in above our forecasts. And that never happens at the start of administration. You remember that the Obama team came in and there were these 4% growth, 5% growth estimates that they said we'd get as soon as we got cash for clunkers passed, right?
Actually,
and those things didn't happen.
James and I were talking about in the commercial break that there was so much anticipation of what you all were doing in anticipation of the corporate tax cut, that people started spending money, companies started unleashing money before, and that's why you saw this big run-up, even before it was passed.
That and dereg. Let's not forget about that. The impact on the economy of the president's efforts to deregulate have been dramatic, and they've been quicker because we can do a lot of that without congressional intervention. So that's what I think you're seeing flow through the system right now. I just think you're starting to see the impact of the tax.
And there was one other little thing that's an interesting thing for data wonks like Maria, that because you could deduct the cost of buying a machine, you could expense it in the fourth quarter because the bill was retroactive. Then all of a sudden in December, firms saw that, well, if I buy the machine now, then I can deduct it at 35% instead of 21%, and that's a much better deduction. And so they piled a whole bunch of investment into the fourth quarter. So then when investment was high in the first quarter as well, that meant that we started a capital spending boom.
Okay, so far so good. You can take a victory lap on the tax cut, the investment that's resulted, but we're still not seeing the job creation we'd like to. Are you expecting that?
I'm sorry, what?
In the sense that businesses...
All right, 3.8%.
How much more can we take?
Yeah. Let me put it this way. Businesses can't find the workers they need.
Okay, all right, that's a different story.
And job creation in terms of people coming off the sidelines, maybe they were discouraged during the Obama years. Maybe they're in a situation where they're looking for the right flexibility in a job. But do you see that picking up as we go along this year?
I do. In fact, I think you've started to see it already. One of the reasons I think we've been able to have the growth without the inflation is that folks are coming back into the market. I think the number I've seen is like 600,000 folks have come back into the job market. So I think you're already starting to see that.
And like the president, I'm looking forward to the next jobs release. And I think that when the jobs release comes out, then we'll redo the estimate. But the last time we did the estimate, there are 900,000 people that have a job now that were out of the labor force when President Trump was elected. 900,000. And so people are coming back in because wages are going up and the labor market is tight.
Director Mulvaney, let me ask you, because you have talked about your new pick for the CFPB.
BCFP.
right, the Consumer Protection Bureau. My apologies. And now there are reports that General Kelly may be leaving at the end of the summer. Does that mean that you are going to be a contender for the Chief of Staff job?
I have heard those same rumors about 3 times now in the last 12 months. I'll start dealing with that issue when the president actually raises it with me as opposed to the media, and that hasn't happened yet.
What has the agency done to change and gotten smaller?
The Bureau?
Yeah, the Bureau.
The Bureau has just decided they're going to enforce the statute. They're still enforcing the law. They're still protecting consumers. They're still following the law. We're just not pushing the envelope anymore. We're not looking for reasons to sue people. We're going to find people who really are bad actors, and we're focusing our attention on them, which we think is entirely consistent and supportive of the law.
And Kevin, before you go, let me ask you this. In terms of the training and these industries that are so important to growth, like AI, like robotics, a lot of people say, look, what does a steel worker know about AI? What does a bus driver know about robotics? How are we going to get Americans up to speed in terms of the industries that are the growth stories of tomorrow and train them so that they can thrive in this new economy?
Well, you're right, and we've got a lot of work going on studying training programs. At the CEA, we've been working on a report to pick out the ones that work and the ones that don't and ways to reform it. But I think that the best way to think about it with all this capital coming into the labor market is that the capital is going to make workers more productive. So just like when you're sitting at dinner and you're arguing over, who wrote that book, and you Google it right away, like you can learn stuff right away now. And when you start integrating that kind of access to knowledge to machines and everything else, it makes workers more productive, it drives wages up, and it makes training easier, not harder.
Great to see you both.